Warren Buffett, Charlie Munger, and Peter Lynch. What do these people have in common? Well, they're better investors than you. Investors like you are prone to make many mistakes in your investment strategies, which may cause you to miss out on earnings or even lose money. It seems like these people are far above the average investor, but all they do is follow some simple rules. Here are some of the investing rules that the rich follow that you don't. Number 1. Not emotionally investing. One mistake people make when investing is letting their emotions guide their decisions. This means buying or selling stocks based on fear, greed, or other emotions, rather than on sound investment principles. It's easy to get caught up in the excitement of the market or to panic when stocks start to fall. However, making investment decisions based on emotions rather than rational analysis is a recipe for disaster. There are many fluctuations in the market in the short term, but detach yourself from that and you can reap the benefits of the long term. The rich take a more disciplined approach to investing. They make decisions based on data, research, and analysis, rather than on emotions. They also have a long-term perspective and understand that investing is a marathon, not a sprint. Take a look at the S&P 500, for example. There are many ups and downs, and things definitely look unpredictable. A newbie investor may look at this and not be sure about buying some of this stock, but looking at it since its inception, things look a lot simpler. You can tell a lot about an investor based on the timeline they think in. Poor investors think in months, while pro investors think in decades. If people kept calm and stuck it through the hard times, a lot of the problems people face could be solved. Number 2. Trying to time the market. Timing the market refers to where a person obsessively sells and buys stocks in order to maximize their returns. This sounds good in theory, since if you buy low and sell high every time, you should start raking in the money pile soon, right? Well, that would be true if you knew what the hell you were doing. Attempting to time the market often results in missed opportunities and lower returns, as investors may miss out on gains if they are not fully invested during periods of market growth, or may incur losses if they sell their holdings during periods of decline. Think back to the S&P 500. Think of all its ups and downs on a short-term basis, but its growth in the long run. Trying to time this market, if you don't know what you're doing, could cause you to miss out on its best trading days. If you miss the market's 10 best days over the past 30 years, your returns would have been cut in half. Once again, the rich are thinking about investing in the course of decades, so they don't bother themselves with the day-to-day fluctuations. Letting the economy run its course has benefited them in the long run. Number 3. Being too arrogant. Ever heard the term the Dunning-Kruger effect? It's the effect where someone completely new to something thinks they know everything, while someone who knows a lot believes they know nothing. Here's a graph of it, where someone at the beginning believes they know it all on Mount Stupid. Even an expert doesn't believe they're that good. How does this come back to investing? Well, let's go back to the newbie investor who tries to time the market and uses emotions to invest. Let's say he gets lucky in his first month and makes a few $100s. He chose a few stocks on baseless reasoning which happened to go up. He's feeling good, on top of the world. He's the kind of person that starts bragging about his newfound genius to his friends, despite only going at it for a week. However, he soon realizes that luck was all it is, and he's back to square one. Meanwhile, the smart investor knows that he doesn't know everything and isn't likely to beat the market, so he picks some reasonable index funds that ride the market historically. He doesn't even look at the money as to not be tied to it emotionally. He lives his normal life. Eventually, he sold off his millions, since he played it smart.